In my last video, I ended off on two questions. The first one is, why is it that most people think that we are heading towards an inflationary economic environment during a recession? The answer to this question is, of course, the Federal Reserve. Now, the other question that I posed, which I'm going to answer in this video, is what is it that the Federal Reserve is doing that makes everyone think that we are heading towards inflation, where the dollar crashes, stocks continue to go up, and especially gold and Bitcoin and real estate continue to soar in price during an economic recession? In this video, I'm going to explain what the Federal Reserve is really doing, how the monetary system works, the truth about money printing, and I'm also going to answer whether or not we're going to witness a Venezuela type inflation where the dollar crashes, or whether or not we're going to experience a Great Depression kind of deflation where asset prices collapse. So what is it that the Federal Reserve is doing? Well, first off, let's ask, what can the Federal Reserve do at all? The Fed has three main tools that they can use. The first tool that the Federal Reserve has is what's referred to as forward guidance, which basically just means that the Federal Reserve can communicate to the public and basically let them know what their future projections are and where they see interest rates going in the future. This can impact the actions and decisions of people, investors, and businesses based upon the expectations and the information shared by the Fed. The second thing that the Federal Reserve can do is adjust the federal funds rate, or interest rates. This is the interest rate that banks charge other banks for borrowing money. And it's also the same interest rate that applies to most US savings accounts. The third tool that the Federal Reserve has is the ability to engage in open market operations. And this basically just means that they can buy and they can sell things, especially in the bond market. In this video, we're not going to talk about the impacts of forward guidance because it's literally just talk. And last time I checked, I don't think the Federal Reserve can create inflation by just talking. This leaves us with the Fed's ability to adjust interest rates and also buy and sell things in the open market. The funny thing about these two separate tools is, in reality, they're basically one and the same, because you can't have one without the other. Let me explain by first posing a question. Do you know how the Federal Reserve can change interest rates? Well, if you said by flipping a switch, I'm sorry to say that you are incorrect, because I already tried that. So here we have the ultra low Fed funds target range. All right, let's try to raise interest rates. So let's see if the rate range went up. Let's see. Dang it. Maybe I need to try a different switch. Instead, the Federal Reserve is able to adjust interest rates by doing, you guessed it, open market operations. So when the Federal Reserve faced the economic shock back in March, the Federal Reserve brought down interest rates from about 1.75% down to the range of between 0 to 0.25%. They did this by going into the bond market and the derivatives market and buying up hundreds of billions of dollars of US Treasury bonds and asset-backed securities. Now, you may be asking right now, well, why does the Federal Reserve buy a bunch of Treasury bonds when they want interest rates to go down? The reason that the Federal Reserve buys up a bunch of Treasury bonds when they want interest rates to go down is because bonds and interest rates have an inverse relationship with one another. So when bond prices go up, interest rates go down. And when interest rates go up, bond prices go down. So why is it that the Federal Reserve wants low interest rates right now? And is this good for asset prices? In regards to this question, Warren Buffett has been known to say that interest rates are to asset prices what gravity is to the apple. When there are low interest rates, there is a very low gravitational pull on asset prices. So Warren Buffett is saying that low interest rates are good for asset prices. And we can see clear proof of this when we look at the US stock market performance and also the US real estate market over the past 10 years. During a time where we've had extremely low, artificially low interest rates. This is because low interest rates really hurt savers. And so most people end up putting their money into the financial markets instead of holding it in a savings account. Because with a savings account and low interest rates, they're not getting any return for their money. This results in sky-high asset prices in a very fragile financial system. So now that we understand what the Federal Reserve can do, and the two main things are adjust interest rates and buy and sell securities, which are basically one and the same, And now that we also understand why they want lower interest rates, which is basically to boost asset markets and stabilize the economy, where does the whole inflation argument come into play? Why is it that so many people think that the Federal Reserve is going to crash the US dollar? Well, the reason why many people are afraid of inflation right now is because in this process of the Federal Reserve buying up bonds in order to decrease interest rates, they're actually creating currency in the financial system. The way this all basically works is that there are these big bond auctions that sell off our government debt to foreign investors, domestic investors, and these primary dealer banks. These banks buy up a bunch of bonds and end up selling them to big commercial banks for a cut. The commercial banks buy these bonds from the primary dealers because they know that the Federal Reserve needs these bonds in order to keep bond prices up, in order to keep interest rates low. And so they know that the Federal Reserve needs these bonds and they're willing to pay a premium for them. And as you may suspect, the commercial banks then take those bonds and flip them over to the Federal Reserve and make a profit in the process. This results in the Federal Reserve being able to get the bonds that they need in order to keep interest rates low. And this also gives the banks and the primary dealers little bits of profit in the process. Now, where this starts getting interesting is when you ask, what are the banks getting in return for when the banks sell the bonds to the Federal Reserve? They're getting money, right? They're getting cash. That's money printing, right? Not so fast. This whole process is known as quantitative easing. And most people explain quantitative easing by just simply saying money printing. The problem with this definition is that it's partially true, but technically not. And it's also very misleading. Now, it is true that when the Federal Reserve and the big banks do this transaction, in the process, it basically creates new currency in the financial system. Because when the big banks take these bonds and sell them to the Federal Reserve does not have any money to actually give to the banks in return. What actually happens is when the Federal Reserve receives the bonds from the banks, the Federal Reserve makes an electronic ledger entry that digitally deposits new currency, which are called bank reserves, into the checking accounts of the banks that are held at the Federal Reserve. Now, I know that sounded a bit complicated, but you can kind of think of it like how you may have a bank account or a checking account that's held at a big commercial bank. Well, these big commercial banks, they also have bank accounts, and these are held at the Federal Reserve. You can kind of think of the Federal Reserve as like the bank of the banks. What we have to figure out is what is the impact of these massive amounts of bank reserves that these banks are getting in return for the bonds that they're selling to the Federal Reserve. What can the banks do with these reserves, and is it creating inflation? Are these bank reserves going from the Fed and going into the economy and creating massive amounts of inflation? These additional bank reserves lower the financial risk that banks face and also give them the capacity to do more lending if they choose. Now, for the million-dollar question, are these bank reserves and all of this quantitative easing that's happening directly inflationary? The shocking answer is that it depends. The reason that it depends connects directly to my last video, where I explained why deflation is the biggest financial concern right now to investors. That's because under our current monetary system, without lending growth, you don't have inflation. And I explained why this is and a lot of other things in my last video. So be sure to check that one out if you haven't already. So ultimately, it all comes down to lending growth. If lending growth is positive and credit is expanding in the economy, then all of these bank reserves that are trapped in the banking system, in the financial system, will start entering the real economy. This will increase the money supply and therefore create higher prices as a result of that inflation. However, if lending growth is stagnant or in decline because people and businesses aren't willing to borrow money and or banks aren't willing to lend out money, then this is by definition deflationary. So you might be wondering, is lending growth expanding or is it contracting? And the answer is that it's contracting. It's been contracting for several years and has still been contracting even since the Federal Reserve brought down the federal funds rate all the way back down to around 0%. At the end of the day, the members of the Federal Reserve can say whatever they want during the FOMC meetings. And they also can do whatever they want with interest rates. And certainly they can buy a lot more things than you or I. However, 3 things that they can't do. Number 1, they can't make people borrow money if they don't want to borrow money. Number two, they can't force banks to lend money. And number three, they can't print money or bank reserves and inject them directly into the real economy. For now, at least, the Federal Reserve still has to operate under the constraints and limitations of the current monetary system. And therefore, given all of this, I conclude that we will experience severe deflation before we see any significant inflation. However, I want to make sure that everyone is ready for either scenario. And so in my next video, I'm going to explain the important conditions for deflation and what would have to happen in order to increase the likelihood that we will go from where we are now straight to high inflation. Thanks so much for watching. I hope this was helpful. And if you have any questions, let me know in the comments below, and I will see you all in the next video.